Oh, India is 19 employees benefit. So employees benefit, how I am going to have an India is it's ridiculous, na, sir. Employees la we need India is, sir. Sir, what is the necessary for this India is? First, for employees mainly. Employee we going to use salary, right? Then benefits we will account of it. Correct. Then what any liability rise through employment, employer need to pay na, he will take care of this. The three things we're going to see. Nothing more than linked to the employees and other than company. So how the India is going to affect this? We will read. The objective of the standard to prescribe the accounting and disclosure of employee benefit. So what is a disclosure? So the disclosure to be given in the financial statement. That is the objective of it. The standard requires entity to recognize liability when an employee has provided service in exchange for employee benefit to be paid in future. So what need to disclose? So these many employees had provided this kind of service. So for that service in exchange we are giving some benefits and that is to be paid present and future. Expense when entity consumes economic benefit arising from service provided by the employee in exchange for employee's benefit. What is the expense that the company is going to incur and what is the expense the entity consumes the economic benefit arising from. So we are consuming some economic benefit from where we are consuming from the society economy of what kind of benefit service we are getting some benefit from whom we are getting from employee, and for the employee of consuming that in exchange what we are giving him employee benefit we are giving. Employee benefit is all form of consideration given by the entity in exchange of service rendered by the employees or for the termination of employment. So benefits is like for the service we are going to give, or in the case of termination of the employee from the company, we are liable to give something. This is what this benefit said. So what does a benefit include? Short-term employee benefit, post-employment benefit, long-term employee benefit, termination benefit. Short-term employee benefits, he comes, he work, he get the paid wages. Post-employment benefits, he worked for some part of time, then after getting salary. Other long-term employee benefit, PF we are giving, bonus we are giving. Termination benefit, gratuity we are giving, gratuity we are giving. These are the benefits we are giving given. Short-term employee benefit. What is short-term employee benefit? Short-term employee benefits are employee benefits other than termination benefits, other than insurance benefit, all things are short-term benefits. These are expected to settle wholly before 12 months. 12 months before less than 12 months, it will be settled after the end of annual reporting period in which employees render related service. Like what bonus they will pay, salary they need to pay, wages they need to pay, this kind of some kind of provident fund they need to pay. Now, these are the things they are saying. The short-term employee benefits include items of following. It expected to settle wholly before 12 months. So 12 months duration for short term from the end of annual reporting period. Annual reporting period is financial year from what April to March 31st. Wages, salary, social security contribution, PF, ESI contribution, paid employee annual leave, paid sick leave. So every year we would give some number of days as a leave, that is paid leave as annual leave, and if anybody takes sick also, we provide salary for them. Profit sharing and bonuses. You do this contribution, we get this benefit. If we get this benefit, you will get a part of it. And bonus as per the bonus act. Non-monetary benefits such as medical care, housing, car, free, subsidized goods and service for current employees. These are all short-term benefits. When an employee has rendered service to an entity during an accounting period, entity should recognize the undiscounted amount of short-term employee benefit expected to be paid in exchange of service. So I need to pay some money. Can I discount it right out and account it, and when I pay it, I consider as interest? No, you can't do it. Whatever the amount need to be paid should be an undiscounted amount as liability, accrued expenses. It could be considered accrued expenses after deduction any amount already been paid. So the amount what is going to be paid should be deducted. Then after it should be shown TDS to be deducted. That amount should be considered as liability. Why section 192 we need to pay it. We need to deduct TDS from salary and remit to government in form of TDS on salary on base of the income tax. That need to be deducted. Then the remaining amount to be considered as the employee salary payable. Then if the amount is already paid, exceeds the undiscounted amount of benefit, the entity should recognize the excess as an asset, prepaid expenses to the extent that employer prepayment will lend to, or for example, reduction in future payment or cash refund. Sir, sometime we paid salary, sir. The salary amount is 100, we pay 102 rupees. The 2 rupees is prepaid expenses. We should consider prepaid expenses or it can consider as asset for repayment that lead to future reduction. Yeah, this is what concept. As expenses, unless the NDA is required or permits the inclusion of the benefits of cost of asset. So it can be considered as expenses only when the NDA is permitted and that is included in the inclusion in the cost of the asset. So next. Post-employment benefit. What are the post-employment benefit? The post-employment benefits or employee benefit other than termination benefits or other than short-term employee benefits that are payable after the completion of employment. Sir, I'm completing the employment of 5 years or as per my contract, I'm doing this service. After that, I will be terminated. After the employment, I'm going to give something. That is post-employment benefit. What are the post-employment benefit, including retirement benefits like pension, lump sum payments, etc. Other post-employment benefits such as post-employment life insurance, post-employment medical insurance. These are the benefits which is given by the employer to employee. Post-employment benefit plan, defined contribution plan, and defined benefit plan. These are the post-employment plans. Defined contribution fund. What is a defined contribution plan? The defined contribution plans are post-employment benefit plans under which the entity pays a fixed contribution into separate fund. A different amount of a small amount is given into a contribution fund which has no legal constrictive obligation to pay further contribution if the fund does not hold sufficient asset to pay all the employees benefit relating to employee service in a current and prior period. A defined contribution plan is like I want to pay gratuity. Yes, I want to pay gratuity. So what I'm doing, I'm not going to pay gratuity. I'm going to make a contribution to gratuity fund, which is in the LIC. It is in a contract. Every month I will pay something at the time of employment, at the time of what employee leave the organization. They will queue form an amount and they will queue to the employee when he retired. This is the employee gratuity contribution fund. Under the defined contribution plans, the entity's legal and constructive obligations are limited to amount that is agrees to contribute the fund. So company will agree we should contribute this much amount. The amount of post-employment benefit received by the employees is determined by the amount of contribution paid by the entity and perhaps also employee to post-employment benefit plan as to the insurance company. So the insurance company employee will also may contribute, but the employer must contribute together in the investment return arising in the contribution. In consequence, actuaries risk the benefits will be less than expected. So sometimes due to actual risk, the benefit may be less than what they expected. The investment risk, the asset invested will be insufficient to meet the expected benefit. They have believed though this will be the growth of the asset. We have invested something, but the expected is much lesser than what we expected in substance on the employee. So it will fall in substance of the employee. Employee will bear a loss on that date. And the employee has rendered the service to the entity during the period. The entity should recognize a contribution payable to a defined contribution plan, exchange of the service. For the exchange, what is the employee will get? We should think about it. and they should get the money return, and they need to pay the amount. It should not be a kind of all gambling. Actually, the amount we pay as a liability, accrued expenses after deducting any contribution already paid. If the contribution, so any of salary minus deductions, tax minus TDS minus gratuity, employee contribution minus any other contribution, ESI contribution, and any other insurance contribution made by the employee is all deducted. Then after coming, the net amount is the liability amount. If the contribution already paid excess the contribution due to the service before the end of reporting period, the entity shall recognize the excess as an asset or a prepaid expenses to the extent that the repayment will lead to, for example, reduction in the future payment of cash refund. If the money is paid already, money is paid more than whatever necessary, then what will do? They will consider as an prepaid expenses. If not, the NDAs doesn't permit it. The NDAs doesn't permit this. It will be included as a contribution fund or it will consider as an asset. And if it permitted, it would be considered as expenses. If not permitted, it won't be considered as expenses. Defined benefit plans. What are the defined benefit plans? Defined benefit plans are post-employment benefit plans other than defined contribution plan. So, defined contribution plan is I will give this much amount, you will get something. Defined benefit plan, whatever I contribute, I will get something out of it. Defined benefit plans, entity obligation to provide agreed benefit to the current and former employees. So, who are the employees? And the employees in a company, and we agree to pay a defined amount when you get out of the company, when you follow the works and you contribute your economic benefit to the company, we will have a defined plan. Actually, risk, that risk that cost more than expected. So risk, so we may provide something, we may not get the same thing. And the investment risk falls and substance of entity, if the actuaries or investment experience are worse than expected, entity obligation may increase. If the actuaries may say that, sir, we may receive this kind of amount, but unfortunately, we didn't get that amount. Now, what happens? Then, then what happens? Then it becomes a risk in the kind of company. The company need to contribute more than actual. Yeah, this is the problem. The accounting of the entity of defined benefit plans involves following steps: determining the deficit and determining the surplus. What is the contribution one mean? What is the expected? What is the actual receipt? We will see this, and if it is like the actual contribution is excess than the expected amount, then good. But what is expected is less, but the actual result is more. That is a gain, surplus. If we didn't get that, it's a deficit. Then company need to put their own money into it using an actuarial technique to make a reliable estimation of ultimate cost to the entity for the benefit that the employees have earned in return for the service in the current and prior periods. What they are saying. So we have contributed something that money we will get some return. Yeah, and for that the service we got earlier in the previous year in the current and prior periods we need to give benefits to the employee. The ultimate cost is burden on the company. Well, how we, through the contribution, actuaries will find what should be the contribution, what was the expect amount. Do we need to increase the contribution right or we can maintain the same thing, or we need to reduce the contribution to get the actual expected benefit that we promised to the employee to give to the employee. Discount the benefits to determine the present value of the defined benefit obligation and the current service cost. So these many employees have, if they terminate in this period, what is the amount I'm going to give on that present value? What is the present value? And we discounting that, and whether the contribution is meeting the present value that we need to see. Deducting the fair value of any plan assets from the present value of the defined benefit obligation. What they are saying, sir, this is the plan. What is the fair value of the plan asset and the present value of the defined benefit obligation for the right now? If the obligation arises, whether the plan can provide the benefit, and what is the present value determining about the plan that that is being sufficient for satisfying the benefit. Determining the amount of the net defined benefit liability, net defined benefit asset as the amount of deficit, amount of surplus, adjust to any affected limitation, not defined benefit asset or not defined asset ceiling. We need to see this in a different concept. What is this? Determining the amount of net defined benefit liability as amount of a deficit or surplus adjusted by affecting the limiting of net defined benefit asset to the asset ceiling. We want to see, sir, if this liability comes today, what is the benefit we have? Will it match it? If it matched, now no problem. If not matching, we should consider as liability. If it has been more than what we expected, then it is asset for us. Determining the amount to be recognized in profit and loss account. So when it is, what are the amount to be considered profit and loss account? Current service cost. What is the employee paying? Past service cost and gain and loss and settlement. So we have monthly this much contribution and the for these individuals, and the contribution is matured. On that maturity we pay to the employee. On that maturity we have gain or loss that we need to see. Net interest on the net defined benefit liability. If not, if we need to pay something out of our pocket, what is the net benefit? It is a asset or liability, we need to compare. Determining the remeasurement of net defined benefit liability to be recognized in other comprehensive income comprising actuary's gain and actuary loss. What is a gain? What is a loss? Yeah, we need to see now actuary gain is very important. If we gain something, rather we have invested something, we need to get something to pay the employee. If it is actually gain, then actual contribution may reduce. If it has been lost, now we need to more contribute. We need to contribute more. The return on the plan asset, including amount included the net interest on the net defined benefit as liability. Return on plan asset. So what is the return on the plan we executed so that whether it's a net interest is an asset or liability. Yeah, we put 100 rupees, we expected around 150 rupees. The 50 rupees if we get, it is a interest amount, it's a gain. Or if we got only 130 rupees and 20 rupees we want to put out of our pocket, then benefit is 30 rupees of interest. But in the same case, 20 rupees liability we income. Any change in the effect of asset ceiling, excluding amount, including net interest on the net defined benefit plan. If there any change in the asset ceiling, what kind of change may occur? We have given more asset has increased the value as the expected benefit asset value has increased. So the benefit is increased, right? The asset ceiling has increased. Such a way to be considered. The entity shall determine the net defined benefit asset or sufficient regularities. The amount recognized in the financial statement do not differ materially from the amount that would be determined at the end of reporting period. So whatever the contribution may need should be mostly similar to the actual payment that need to be paid on the maturity date to the employee. When the risk arises, we need to pay to employee some defined gratuity pension amount that should be same as of what the we need to pay. That need to be properly accounted and the risk should be assigned, risk should be found out, and there should be no risk and we need to pay the contribution. It should be timely manner. Accounting for constructive obligation. What is accounting for constructive obligation? The entity shall account not only a legal obligation under the formal terms of defined benefit plan, but also constructive obligation that arising from entities informal practice. To the practice, we will see what is the benefit, what is our benefit. Informal practice gives rise to constructive obligation when the entity has no realistic alternative but to pay employees benefit. They need to pay the employee benefit as a no interest alternative. Example of a constructive obligations where change in the entity's informal practice should either unacceptable damage to a relationship with the employee. So whatever we need to pay, we need to pay. There should be an obligation. Constructive obligation arises from the entity formal practice. We need to pay this much amount as PEF. salary, bonus, gratuity, and retirement benefit, everything to be constructively recognized and need to pay. There should not be what any unacceptable damage in relation because of this kind of contribution not being paid to employee. That will create a bad name to the company, and that will comes up with the lawsuits, which is dangerous to the company's certainty and going concern. Multi-employer plan what? A multi-employer plan is defined contribution plan other than state plan, a defined benefit plans other than state plans. That is, a pool of assets contributed by various entities that are not under common control. Use of the asset to provide benefit to employees more than the entity. And the basis that contribution and benefit leaves are determined without regarding identity of the entity that your employees, the employer, the employees. Multi-employer now example, a employee may be engaged by this organization and that can be used by various employees in various projects in the company. So that the contribution, like now corporate culture is like that. One company will hire the employee and that company will train the employee, and the trained employee will be used by various organizations and various projects. Why? To reduce the cost of employment. What is the benefit out of it? These employee will be considered as contractual employee. There will be no major cost for the company. There is no annual salary. Now, if there is employment, they need to take. If not, that company who hired will pay. And the entity should set a classify multi-employer plan as defined contribution plan or a defined benefit plan under the terms of the plan, including any contract constructive obligation that goes beyond the formal terms. Yeah. Other long-term employee benefit. What are the other long-term benefits? Other long-term employee benefits are all employee benefits other than short-term long-term benefits, more than 12 months period. The post-employment benefits, that termination benefits, usually gratuity. Other long-term employee benefits include the following: are expected to settle wholly before 12 months after the end of actual reporting period, or the employee render the rate service. These benefits are not expected to be settled after within 12 months of the period of reporting period. It will be extended long. How, like long-term paid absence or long service of sabbatical leave. They took a long leave, for that leave they will pay. Jubilee, other long-term services. For the service what they did, they pay. Long-term disability service. A employee during his employment in this company got an injury, become disabled. For this disability, company is paying some amount. Profit sharing and bonus. We will give ESOP, employee stock option plan. With that, you get a benefit share options, and more than that, we will give you dividend, a profit on this plan. Deferred remuneration. The remuneration is this much. We will give more than the remuneration in the period. If it achieve this, we will give you. A remuneration is not paid now; it will be paid later based upon the achievement. A standard does not require the measurement of long-term employee benefit as the same degree of uncertainty as the measurement of post-employee benefit. So there is a great difference between long-term benefits and post-employment benefits. And standards not required to measure with the same degree as post-employment. You should see in a both in a different scale. Standard requires a simplified method for accounting for a long-term employee benefit. So long-term benefit we should see in a simplified form. Unlike the accounting requirement for post-employee benefits, the method does not recognize remeasurement other than comprehensive income. So it does mean not considered in the other comprehensive income. Termination benefits. What is the termination benefits? Termination benefits are the employees' benefits provided exchange for termination of employees' employment, the result of either entity decision to terminate the employee employment before the normal retirement date. He going to retire at the age of 60. Before that, we are giving voluntary retirement scheme. For that, we are paying a huge amount. That is termination benefit. Employee decision to accept the offer of benefit in exchange of termination of employment. Company will say, if you terminate right now, we will pay you 9 months pay right now. That's kind of thing. Entity should recognize a liability and expense of termination benefit at the earlier of the following dates. An entity can no longer withdraw the fund of the benefit. So, or the entity recognize cost for restructuring that within the scope of Ind AS 37 and involves a payment of termination benefits. So, entity should recognize the liability and the expenses of termination benefit. So even the employee is not terminating, entity should recognize when the entity is no longer withdraw the offer of the benefit. Um, Entity thinks so. We don't want employees. We don't want any kind of employee benefits. We need to close all the employees. Then we need to consider this. Entity recognize cost for restructuring. So the entity think that as per NDAs, we want to restructure the company and we're going to go for amalgamation something. We don't know the certainty of the employees. Then we need to consider all this post-employment benefits and accountability. Entity should measure termination benefit in initial recognition on the first hit of the new to consider and should measure recognize the subsequent changes. And after the change happen, what should be the account? It should be accounted. In accordance with the nature of the employee benefit, it provide that if the termination benefits are enhanced to post-employment benefits, the entity should apply the requirement of post-employment benefit. Otherwise, there is a different angle for post-employment benefit and termination benefits. What often the employee had done its service, then it is post-employment benefit. Termination benefits. The employee, his time is there, but the company thinks it fit to get the employee out, or the employee is being thrown off to the company due to restructuring. This is termination benefit. If the termination benefit is expected to be settled wholly before 12 months after the end of annual reporting period in which termination benefit is recognized, the entity should apply the requirement of short-term employee benefit. If it going to terminate now, it is not 12 months after, within 12 months. So this termination became a short-term employee benefit. If the termination benefits not expected to settle the whole before the 12 months after the end of annual reporting period, the entity should apply the requirement of long-term employee benefit. It is not going to settle it right now. It will take 12 months or more. Then it will become a long-term employee benefit. So the post-employee benefit even considers a short-term employee benefit, or you can consider the long-term employee benefits. So this is all we need to understand regarding employees' benefit. Thank you. Om Shanti, Shanti, Shanti.